Ever feel like investing is just too much? Too complicated? Maybe too expensive to even get started? Well, you're in the right place. We're going to break down one of the absolute best tools for building wealth. And trust me, it's way simpler than you think. Let's get into it. Seriously, think about this for a second. What if you could invest in, say, 500 of the biggest companies out there, but you only had to buy one thing? No more trying to guess which stock is going to be the next big winner. You just buy them all at once. Sounds kind of like a cheat code for the stock market, right? Well, it's totally real. And that's exactly what we're talking about today. Welcome to the world of ETF investing. ETF stands for Exchange Traded Fund, and it has completely changed the game for regular people looking to build wealth over the long run.
Okay, so let's start right at the beginning. What even is an ETF?
All right, so here's the textbook definition. An exchange traded fund is a fund you can trade on a stock exchange, kind of like a stock. A little dry, right? But don't worry, there's a much, much easier way to think about it. This is the best way to picture it. Think of an ETF as a shopping basket. And inside that basket, you've got tons of different stocks, sometimes hundreds, even thousands. When you buy just one share of that ETF, you're actually buying a tiny little piece of everything inside the basket. It's like buying a ready-made, diversified portfolio with just one click. And what's so cool is the sheer variety of these baskets. You can get a basket that holds the 500 biggest US companies. You've probably heard of that, it's the S&P 500. Or you could grab one that's just full of tech companies. Or maybe you want to invest in companies from all over the world. Yep, there's a basket for that. Even things like bonds or real estate. The point is, you can invest in a whole slice of the economy instantly with just one purchase.
So why is this basket thing such a big deal, especially if you're just starting out? Well, there are three massive advantages that make ETFs pretty much the perfect place to begin your investing journey.
First up, and this is a big one, diversification. You know that old saying, don't put all your eggs in one basket? That's exactly what an ETF does for you, automatically. Because your money is spread across so many different companies, you're not betting everything on just one or two. If one company has a really bad quarter, it's not a disaster because all the others in the basket help cushion the blow. It's a built-in safety net. Number two, they are ridiculously cheap. Seriously. Most ETFs have a tiny yearly fee, something called an expense ratio, that's often less than 0.1%. Let's put that in perspective. If you invested $10,000, you'd be paying less than $10 a year in fees. That's it. The reason they're so cheap is that they're usually just set up to automatically follow a market index, so you're not paying some high-priced manager's salary. And that means more of your money stays your money, growing for you. And third, maybe the best part of all, they're just simple. This isn't about being glued to your screen, watching stock tickers go up and down all day. No way. For most of us, ETF investing is a set it and pretty much forget it kind of thing. You pick a good, broad ETF, you keep adding to it over time, and you just let the market do its thing for the long haul. And look, it's not just me saying this. The proof is right here. That magic combo, diversification, low cost, and simplicity, is why basically everyone, from brand new investors to Wall Street pros, uses ETFs as the backbone of their long-term strategy. It's just smart. Okay, I bet you're thinking, this all sounds great, but how do I actually, do it? Perfect question. Let's get down to brass tacks. Here's your simple step-by-step action plan. First things first, let's get one myth out of the way. You do not need to be rich to start investing. Forget that image of needing thousands of dollars. These days, you can get started with as little as $10 or $100. The barrier to entry is gone. And the actual process, it's literally as easy as 1, 2, 3. Step 1, you open up a brokerage account. That's just the fancy name for the app or website where you'll buy your investments. Step 2, you search for the ETF you want by its little nickname called a ticker symbol. And step 3, you decide how much you want to invest and tap that buy button. Boom. Just like that, you're an investor. Now, if you're thinking, okay, but where do I open an account? Here are some of the big trusted names in the game. You've probably heard of some of them. Just doing a quick search for any of these will point you in the right direction. All right, let's talk about that second step, finding a ticker. Remember, a ticker is just a short code for an ETF. So for example, if you want that basket of the 500 biggest US companies, you might type in VOO. Want to focus on the big tech names? You could look up QQQ. If you want to own a piece of the entire US stock market, there's VTI. And if you want to invest in companies outside the US, you'd look for something like VXUS. See? Simple codes for simple ideas. Okay,
So we've covered the what, the why, and the how. Now let's put it all together and look at a couple of simple blueprints for your very first portfolio.
Here's a super popular and really solid way to start. It's a simple two-fund portfolio. You could put most of your money, say 80%, into an ETF that tracks the US market like VOO. Then you'd put the other 20% into an international one like VXUS. Why? Because this gives you a piece of the action from both the US economy and the rest of the world. It's a fantastic, simple strategy for long-term growth.
But hey, what if you're a bit more cautious? Or maybe you're getting closer to retirement and don't want as many ups and downs. No problem. You could go for a more conservative option. Here, you'd have a little less in stocks and add a third fund, a bond ETF, like BND. Bonds are usually much steadier than stocks, so they act like a stabilizer for your portfolio, especially when the market gets rocky. Okay, and we've saved one of the most important ideas for last. This is the real secret sauce to building wealth over time. It's called dollar cost averaging, or DCA. And all it means is this. You invest the same amount of money on a regular schedule, like say $100 every single month. That's it. You don't try to guess if the market is high or low. You just invest consistently. Sometimes you'll buy shares for cheap, sometimes they'll be more expensive, but over the long run, it all averages out and removes all the stress and guesswork.
So there you have it. The path to building your own wealth has never, ever been more straightforward or accessible. You've got the knowledge, you know the tools, everything you need to get started is right at your fingertips. So the only real question left to ask is, what's your first step going to be?